Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing the Canadian real estate bubble, if you can even call it that. We're going to talk about how we got here, what is allowing prices to continue to go higher and higher and higher, and also what it would take to pop this bubble, again, if you can even call it that, in the future. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video, and don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their monthly rent or mortgage payment for a month just for subscribing to this channel. Thank you to the 1,700 people who have joined us in the last 28 days. I really appreciate each and every one of you. If you haven't already subscribed to the channel, go ahead, hit that subscribe button. It's free and it's definitely worth it. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss the Canadian real estate bubble, because there's a few things I want to go over here. First of all, I want to talk about how we got here. Second of all, I want to talk about what it would take to actually pop this bubble. And I think you're going to be surprised that it would be pretty hard in order to pop this bubble, because there's a lot of things that happened in 2007, 2008. There's a lot of things that happened in the tech bubble and the dot-com bubble in the year 2000 that absolutely do not apply to this situation. And I'm going to talk about all of those later on in the video. But first of all, let's talk about what got us here, okay? Because first of all, pre-pandemic 2020, no one expected the real estate market to be where it is at now. And after the pandemic, when everyone expected that we were going to be locked down for the next 2 to 3 years, we never really expected housing prices to increase either. In fact, nobody saw the fall market coming, and certainly didn't see the early spring market coming that's happened this year. But the reason why is, quite frankly, because when we all got locked down, Federal Reserve banks all over the world had to do something, and that was lower interest rates. And of course, if you lower interest rates, you are going to encourage people to borrow money. And the biggest thing that people borrow money on is housing. And what has happened is we can essentially purchase way more house today than we could pre-pandemic in 2020. And what that means is that people feel more comfortable going out and buying a bigger house. And it also means that they can buy that bigger house with pretty much the same payments that they had previously. Now, combined with the fact that we're eating out a lot less often, our expenses are going down, there's a lot less money being spent on travel, and that compounds the effect, and it creates a scenario where there's even more money that's available to go towards housing. And then combine on top of all of that the fact that people no longer want to be in a small space with their spouse who's at home with them all the time, or their kids who are at home with them all the time, and that's leading to the desire combined with the ability to purchase bigger and bigger houses and basically run up the housing prices. Now, here's something I want to show you guys, because a lot of people don't realize just how much more buying power people have nowadays. Because if you go back pre-pandemic and you look at somebody who had a $775,000 mortgage, now I'm talking about Vancouver and Toronto real estate here with respect to prices, but this translates down to smaller markets as well. And you look at the fact that they were paying around 2.8% back then, and that would give them pretty much a $3,600 a month payment. And then you look at what's happened with interest rates. We see variables now around 1.5% consistently. We've seen fixed rates get pretty close to that low as well over the last year. And you look at how much more you're able to purchase, and you look at the fact that a $3,600 payment now can afford you basically a $900,000 mortgage. And what we're seeing is that ability to borrow more for pretty much the same payment is what's leading to these increases in housing prices. People are going, hey, I can upgrade the house and I can pay what I was paying last year, and because I've got way more money because I'm not going out to eat and I'm not traveling, it seems like it is a lot better decision than sticking where I am right now. And maybe they're right, maybe they're not, but the fundamentals of the fact that people can afford to pay more for houses right now makes sense, especially when you consider it against the fact that housing prices are going up. Now, the thing that people are talking about is whether or not this is a bubble. And let's talk about bubbles for a second, because Canada's real estate compared to what happened in 2007 and 2008 in the US is a completely different story. Because in Canada, in the last 10 years, not only do you have to qualify and prove your income and prove that you have your down payment and prove that you can afford your mortgage, in the last 10 years, the onus to be able to do that has actually increased, because a few years ago we had the stress test introduced, which went a step above what we already had, which was a stress test called debt servicing ratios, which allowed basically 32 to 40% of your income to go towards your mortgage costs, and up to 45% of your income to go towards your total cost. And we basically compounded that by having a stress test, which made it even harder to get a mortgage and basically guaranteed that the housing that Canadians were buying was absolutely and 100% affordable. Because when you look at it right now, basically 25 to 30% of a person's income goes towards housing, which is probably the lowest when you're applying for a new mortgage that it's been in the last 20 to 30 years. Now, compare that to what happened in the US in 2007, 2008. They were doing what was called ninja loans, which was no income, no job, no assets. You could basically walk in, declare that you made a certain amount of money, and they would give you a mortgage. That caused a bubble because there was no limits on what people could purchase for. They could purchase any amount of properties at any price, and all they had to do was say they made enough to afford the mortgage. That isn't what's happening here. So that comparison and that contrasting to 2007 and 2008 in the US just doesn't apply because we never got there with respect to it being that easy to get a mortgage. Now, if you go and you look at other bubbles in recent history, you look at the tech bubble in the early 2000s and the late 90s with respect to tech stocks. And basically what was happening back then was people were buying and selling stocks just on the premise that they were going to be worth something because the world was changing and tech stocks was where you needed to be in order to make your investments. And obviously, a lot of those companies didn't have anything to back them up. They didn't have any assets. They didn't have any actual sales. And yes, the hysteria to buy stocks basically led all these stocks that had no value whatsoever to pretty much collapse. But in this case, we're talking about real estate, which will continue to have at least some sort of value. It's not like they are a tech company that has absolutely nothing to offer, no revenues and nothing else. I mean, land is land, property is property. Yes, there's probably going to be a run up in prices and then some sort of correction when people stop buying more houses or things change, or maybe people want to go back to the urban areas. But for the most part, you can't compare what happened in the tech stock bubble and the 2007-2008 bubble to what is going on in Canadian real estate right now. Now, if we go a little further into this conversation and we talk about what would have to happen in order for this bubble to burst, well, there's a few things. First of all, we'd have to see another big reduction in jobs where people couldn't afford their mortgages anymore. Or we would need to see some sort of liquidity crisis where there wasn't enough money to lend or continue to lend to borrowers and whatnot. Or we would have to see some other sort of financial crisis, or we would have to see rising interest rates. And here's the thing about interest rates. We know this is when we get into low interest rate environments, it takes a very long time to climb out of them. And therefore it becomes very, very hard for interest rates to increase very, very quickly. So I don't think we have a lot of risk there. Now, more than likely what we're going to see is we're going to see this real estate market basically be sustained. I think what we're seeing is probably a new normal. We are going to see as the economy starts to gain steam again, as people go back to work, we're probably going to see more support for the real estate values, not less support for the real estate values. And unless the government intervenes and there becomes some sort of new rule that makes it harder and harder and harder to buy real estate because the government wants to artificially deflate values, well, I think the real estate values that we have here, minus maybe a correction here and there of 4 or 5%, is probably here to stay across the country. In fact, I think in smaller markets that aren't at that $1 million price point yet, we're probably going to see values come up over the next 5 to 10 years to closer to what Vancouver and Toronto represents now. So here's a question that we're constantly being asked, and I've answered in other videos: is now a good time to buy real estate? And well, quite frankly, if you are a speculator, I don't think now is the right time to buy real estate, because we could see a slowdown fairly quickly and we could see a correction in the fall or early into January. However, if you're buying real estate with the intention to live in it and own it for the next 5 to 10 to 15 years, then you probably should be buying now just in case housing prices continue to go up and up and up. There was an article in BNN Bloomberg today, and I'm sorry that I didn't have it available on my screen here for you to see today, but basically what it said is that the short sellers, so the people who sold their properties expecting values to go down, have pretty much been priced out of the market. And that could be what happens for people who expect housing prices to go down and continue to wait. So the best time to buy real estate, as they say, is yesterday. And if you're going to be in the market for the long term, and you're going to be there at least 10 years, and you're going to be able to maintain your job, make your payments, and pay down your principal, I can't see a scenario where somebody who buys real estate today isn't better off 10 years down the road. I can see a scenario where somebody waits and continues to have to pay higher and higher and higher prices, and this market never ends up collapsing because there's so much things that support it from both an economic and a jobs perspective as things go forward and the economy gets better and better. So I think if you're looking to buy real estate, you should definitely be purchasing it if you're buying it to live in. Speculating, that's a whole nother story. And of course, if you haven't seen the other videos, definitely I think variable is probably the way to go, because I think we're going to be in a low interest rate environment for a very, very, very long time. If you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. Don't forget about our race to 10,000 subscribers, and we'll see you on the very next one. Cheers.